The AI wave is real. The new companies now are getting so much money thrown at them by the big companies. So whether it's Microsoft, whether it's Alphabet, whether it's Meta, whether it's Amazon, these businesses are investing billions and billions behind these AI startups. They will not hire a single employee unless they can be proven that job cannot be done by AI.
Wow.
And so there's an example of a company that is so relevant. The business was doing so well. We had done very well in it. We got concerned about issues around chip supplies to China, restrictions. We weren't sure. We thought, well, it's very highly valued stock, maybe going to get hit. So we ended up selling, and could not have been a worse time to sell.
Marc, thank you for joining me on The Bottom Line.
Great to be here.
Well, we've known each other for a little while, and I loved always catching up with you because you share insights in, what's happening in the market, and I see you as someone I can pick your brain around making money. But before we get into that, let's just dive into your brief history of your professional background, because it is a unique journey.
Yeah, so I've pretty much had a very mixed journey. So originally from South Africa, immigrated to Australia, came here as a physiotherapist. So that was a real change of career for me in about 1999, 2000. The tech boom was happening. I loved the markets. I loved investing, and I thought this is where I want to be. Moved into that side of it, and literally 3 days later, the whole world collapsed with the dot-com crash. And I did my postgrad studying, and I took that time to really, level up my knowledge, and carried on working as a stockbroker from around 2000 out to about 2006, 2007. And then at that stage, my journey kind of changed, and then I felt I didn't love being on that side of the desk. I was dealing a lot in derivatives, and that was highly risky, and I felt the pressure of it was too much, and I thought, this is not where I want to be long term. And that was probably the real change for me in moving from that to managing my own money, investing on my own behalf, and then getting really interested around the GFC in 2008 in global equities. I used to look at businesses overseas and say, wow, we're so focused on Australia, Australian property, Australian equities, interest. And I thought, well, why can't we own Apple? Why can't I own companies that are global businesses leading the world? And that was my first step into global investing, and kind of spent many years doing that. Fast forwards, what feels like a flash, but it was a long time. I think I've known you 19 years, I was thinking, which is crazy. And I came together with two other guys that I knew. One was a good mate of mine, Gavin Donner, who had come from an insurance and actuarial background. He had sold his business, loved global investing. And then Richard Kommel, who had managed money globally around the world in South Africa and in Ireland. He had immigrated here. We started getting together regularly to discuss investing ideas. And I thought, why don't we come together? Let's pool our money, travel the world, meet with companies, invest. And the interest from fellow investors then came. People we knew said, look, if you're doing this, we'd love to invest with you. So we went around setting up a fund, Orsaro Global Fund, properly, did it as we got a license, and, that was the beginning of the journey. And the view with us was really that, remain small, the three of us, which we still are today.
And Orsaro Capital, as it's called. So take us through a little bit about what you do. It's a very unique fund. It's a small fund, like you said. Take us through the journey of sort of where that business started, where it's today, and where you'd like to see going into the future.
Yeah, so we started off as this kind of small boutique fund, and our view was there's not a lot of access individual investors have to fund managers. And our view was that if we can create a fund where a investor can get access, sit down across the table like we are now and chat to fund managers about what they're doing on their behalf, wouldn't this be great, rather than us sitting in a tall building and investors only dealing with, sales staff, etc. And we started off really with the view that we want to be long-term investors. We're not traders. We want to invest globally. We want to take very long-term view on investments to compound wealth over the long period. And the view was that the type of investors we want to attract were those that had made some money in their life through work or business and wanted to compound that for the long term, not necessarily what, a lot of things are out there which are get rich quick scheme. And so starting off in 2018, it was, I would say, we started off probably at a time where things seemed really calm in the world. We've just really had a period which has been non-stop turmoil, which develops you personally, professionally. You know how to handle with this, and you know how to get through these periods that can be pretty tough and volatile. And the first few years were pretty good. Then we hit COVID. That created a lot of turmoil in the markets. And we kind of stuck to our guns. We had our tough periods, we've had our good periods, but for us, it's about consistency in our messaging, in our communication with investors. And where are we today? Yes, we're bigger than when we started, but there's still just the three of us. The Orsaro Global Fund, we've always felt between the three of us, outsourcing the main requirements of the fund allows us to focus on what we love, which is really investing and meeting with businesses.
So we've got a lot of listeners that are small business owners. A lot of them, especially startup or the younger journey, and even some of the mature businesses are investing in essence in their own businesses and putting a lot of the money back into that. But for those that have come out of it with some reserve cash, and some of our younger people that are working and have reserves and amounts that they can invest, take us through what it actually means, the definition of investment. I want to go right to the core. What does it mean to invest, and how do people sort of should think around investment?
Yeah, so before I kick off with that, just my usual disclaimer, we do have a financial service license, but we're only allowed to give general financial advice. So any information, any stocks, I'm not taking anyone's personal circumstances into account when giving that. So investing for me really is investing behind great ideas, great people, great businesses. And what that means is, you are essentially parting with part of your capital to invest behind another company with the view that you're going to get an outsized return on that investment. Now, the risk you take will give you obviously higher risk, higher return, and that's really, fund managers like ourselves decide where on that spectrum they want to be. But for us, investing has got to start at the basics. Is it a business that resonates with you? Does the leadership resonate with you? And do they have the same vision or long-term targets that you do? If it's a very short-term, quick investment, you might want to be a bit more cautious. But if it's someone like who's got a great track record, great business, runs their business efficiently, is friendly towards shareholders, that is someone you want to get behind. And we view that the best investments have been those kind of manager, founder-led companies, great leadership that have long-term tailwinds. We're very keen on tailwinds. We think that you'll give the old adage, when the internet first came about and everyone was piling behind the internet, did you really want to own a business that had the yellow pages? That was a headwind. Whereas companies that could benefit from the internet and then moving on from that, the launch of the smartphones, and now you're getting more into cloud computing, AI. You need to make sure you're always investing behind what these tailwinds are, because that really makes your investing journey a lot easier. And so from our perspective, we look to invest behind tailwinds. We're not deep value managers. What that means is some people like to look at businesses that feel very cheap. Yeah. And sometimes businesses that are cheap for a reason. So we like to look at businesses that we feel there's great upside, there's great tailwinds, great leadership, and that we feel provide a good risk return. So as an investor, that's what you want to look for. You want to look for businesses that you feel can give you that return over the long term. But being in equities, you've got to be prepared to deal with the volatility that comes along with that.
Awesome. So let's take the research element. So an example where we do have an amount of money that we want to invest. How do you go about in researching whether a company is good to their shareholders, they have a vision, their plan? A lot of our self-funded investors that want to do this themselves, they all want to have an interest rather than investing in funds or ETFs or all that kind of stuff. What can they do to do some research, and where can they go? Because I feel like there's so much research available out there through technology, internet, and so on. Where would you recommend that they start?
So the first thing to do, I would say, is avoid the real social media chat room type things, because most people are pushing their own agenda. So my first step, and the way we look at it, is what industry interests you. So if someone's interested in mining, if they're interested in biotech, if you're interested in technology, AI, start with that and then really work down. And then look for the names that you believe are going to be there for the long term. There's a lot of fly-by-nights. There's a lot of companies that are flashing the pan. But focus also, and I cannot stress this enough, on leadership. So the business is one thing. You got to have a tailwind, but you want leadership to be solid. Everyone's a great leader in good times. And I can give you hundreds of examples of this. But when you hit bad times and times are tough, you really find out who the good leaders are. And that's who you want looking after your money. Because as an investor, you've got a leadership team in a company looking after your interests. And you want that company to make sure that when times are tough, they look after you. But when times are good, they also look after you. And what that means is excessive pay is something that can be frowned upon, excessive stock-based compensation. where there was a real push many years ago, especially during COVID, where employees were getting paid with so much stock that it really diluted your ownership of the company. So that is something that for us is a bit of a red flag. You need to feel that we don't like companies that are making, let's say, for example, they have a business that is struggling, and what they go do is try to make transformational acquisitions all the time to try buy revenue. So there's all these different types of aspects we look for, and then we go, well, from here, where do we take this? Then it's about doing the real hard work. Now, that can be from reading a lot of articles, getting access to analyst research. Us ourselves at the fund, we do our own research, and what does that entail? We will go through reams and reams of annual reports, presentations, and we will build a financial model of this company. But then probably the best part, and what we like and maybe differentiates us from some out there, we will actually go on a plane and fly out and meet with companies that we invest in. And, for a little fund in Australia, we get good access to companies overseas. We have good relationships with brokers overseas. We attend big conferences where there's 300, 400 companies presenting. We have one-on-one discussions with management, and you kind of go through that whole period. But that is something we've got the time to do.
Yeah.
But if you don't have the time to do it, there's an amazing amount of podcasts out there. There's an amazing amount of material and interviews that you can look at what management is doing and then kind of come up with your own idea of what this business is. And it's one of the, we always say investing is probably, a doctor has to study for 7 years plus more, become a specialist. I will never tell a doctor what to do, but there's people that have never invested in their life. They're happy to tell me what to do, but it is one of those industries that you can really get access to amazing information. There's so much out there on the internet, but all I'd say is when it comes to social media, and that just be buyer beware. You're always there'll be people out there telling you their company is the best business in the world, and you need to do your own research and be independent.
Well, let's talk about your investment philosophy. So you talked about global. So it is a global fund. So you invest overseas.
We invest globally in developed markets.
Yeah.
And that includes Australia. So we don't exclude Australia, but majority of our investments are based overseas.
And take us through sort of your investment philosophy and the journey that you take. So you talk through leadership, good business plan, good people. When do you sort of assess it and go, okay, we think this stock is undervalued or this stock is going to go up in value? Take our listeners through the journey of how you then evaluate if something is either undervalued or you think is going to go up in price in a long-term view. What does that look like, and how do you navigate through those discussions?
Yeah, so in its purest sense, when we build these financial models I referenced earlier, we will model something for 5 to 10 years and get an internal rate of return. What do we think this company can grow per annum?
Yeah.
And depending on the type of company, we will weigh up whether it's worth investing in. So if you're a low growth big company, we would tolerate a lower rate of return, but something with a bit more volatility, with a bit more high growth, we want something, let's call it north of 15%, 16%. Now, a lot of times when we start that process and we do that, we've come up with an IRR that doesn't make sense. But it doesn't mean we say, no, I'm sorry, we're not going to do it. We actually keep focusing on the company. We keep following it. Because the one thing that I've learned over many years in the stock market, there's always an opportunity. Probably most recent would be Liberation Day, when all these tariffs were announced in April and the market fell dramatically and individual stocks fell significantly. And we did a lot of buying through that period because companies that we've been following for a while or even owned, we felt, hang on, the internal rate of return was 11% 2 days ago. Now it's at 18%. Even accounting for some really tough times ahead, this makes sense. So the internal rate of return and risk reward that we associate around that is centermost to what we do now. Through the years, we've realized that you can get a spreadsheet to justify an evaluation. You can tweak things very nicely, but internal rate of return in the end has always come out as a really good guide for when is a good time to enter and or exit a stock.
And for those that don't understand what an internal rate of return, just in simplistic term, what does that kind of mean?
That means what we believe that the stock will go up per year or increase in value. So if we see something as having a 15% internal rate of return, we believe that can deliver us 15% return per annum.
Yeah.
You compound that over 5, 6, 7 years, you're doubling your money in 5, 6, 7 years.
And let's talk about the Aussie market in the sense the people in Australia. So I talk to a lot of clients, and most of our clients, not most, but a lot of our clients have made their money in property. And I've got clients that will not touch shares either because they've been burnt in the past or they just don't understand it. Talk us through to the people that just do not believe in the equity market, buying shares, investing in the share market, and they just believe in property and leveraging direct property. Can you talk us through sort of how you would try to encourage that person to consider why equities should be potentially something that they should consider in investing?
So when we started, one of our whole founding criteria was that we feel Australian investors have a lot of exposure to their fully franked dividend paying stocks, your big banks, etc. A majority would be property. And we felt there was a good opportunity to diversify away from Australia and property and go globally to what we view as the best companies in the world. Australia is a fraction of the world GDP. Yeah. So let's invest where some of the largest GDP is, so obviously Europe, America, etc. The biggest issue that we found with investors with global shares and Australian shares is that headlines scare them. Property is easy. It's not emotional, because you're not getting a daily basis a headline saying your property has fallen 2% this month or up 2% or on a daily basis. Whereas the share market loves headlines. Every day there's a headline. The market always goes up in percentage but falls in billions. That's one thing you'll notice in headlines. The stock market wiped out $1 trillion today, et cetera, but it went up 2%. That's how the market works. And we laugh at that because that plays on emotion. And what generally tends to happen is when people read that headline and they read articles talking about we could have the worst depression coming and this is going to be worse than the GFC, and it plays on that, they tend to buy at the worst moments and sell at the worst moments. Now, when I say buy at the worst moments, everyone loves to buy when the market's going up because it makes them feel good and it keeps going up, where it should be the opposite. The stock market is the only thing that when it goes on sale, no one wants to buy.
Yeah.
We all walk through Chadstone, we see a sale, we want to buy. The stock market goes on sale, a great business goes on sale, everyone's like, no, it's something wrong with it.
Yeah.
And it's really a psychological thing. And one of the things we like to do with our investors is also be part of an education. Take them through what tough times mean, what they can do, but then show them historically what has happened over time. And there's a lot of really great data out there that will show you that if you have invested constantly in the stock market without reacting to headlines, if you never looked at it, you would have outperformed any asset class.
Yeah.
But you've got to have the emotional side of that. And that's why a lot of people come to us, because personally they don't want to be sitting, looking at their computer screen every day and they see their stocks fall in 20%. It's a hard thing to look at because you feel like you've lost money. But in essence, you haven't lost money until you sell. But if the business is great, this could be one of the greatest opportunities to buy. And what we normally find is people love to look back and go, if only I had bought during the GFC, but wait till the next one happens, I'm going to do it. And you know what? They never do. During COVID, no one bought. During Liberation Day in April, people were running for the hills. There were articles in the paper saying, you got to get out of equities, go order cash. Those are the kind of headlines that we look to and to buy. And so to be a stock market investor and invest globally, you really have to be prepared for volatility. I think those people will know who Warren Buffett is and Charlie Munger, greatest investors in our generation forever. And they've always said, if you cannot handle the value of your share dropping 50%, you should not be investing in equities. And I understand that because, shares can only go down 100%, but they can go up multiples. And if you're a good company, you're a good company. I'm not talking about bad companies. And that is where the research comes in. But your best share market investors are the ones that are non-emotional.
Yeah.
And don't leverage.
Don't leverage. So take us, what does leverage mean? So when you say don't leverage, what does that mean?
So everyone here will know you borrow, go to the bank, you borrow money, you buy your property. You don't worry about the daily move on that. You just make sure you pay it off over the long term. Especially in frothy bull markets, people get encouraged to take out margin loans or borrow money to buy shares. Now, the problem with that is that you've always got to maintain your equity to leverage ratio.
Yeah.
So if the share market suddenly drops 25%, you'll get a call from your broker saying you need to put in X amount of money. And generally what causes this massive panic selling that you see in markets, it really causes that steep sell are people that are borrowed money, cannot afford to put in more money, and what do? They're forced to sell. And forced selling is one of the biggest drivers of these market sell-offs you see during all these tough periods, but it also provides a great opportunity. So from our point of view, we don't leverage in the fund. We use purely the capital we got. We don't take any leverage because we never want to be a forced seller. We want to be a buyer in those situations. And we always encourage our investors that, leverage can be pretty dangerous. It's a double-edged sword and something that we try to avoid within the fund and, personally as well.
I'd love for you to take us through a stock that you've bought in the fund. And if you could sort of take us through the journey of the research, what you thought was going to happen, how you invested in it, got out of it, got into it, and maybe just a thought process, because I know you are long-term holders and there are stocks within the portfolio that you've had different views and ones that you've made some really good calls on. Is there one that you could share with us where you could take us through that story so that it kind of starts to make us think about how we should think about investing through that process?
Yeah, there's so many.
Yeah.
So I've got
Tell us a good one, a really good one that you're proud of.
Well,
And then
I'll tell you one recently that we're proud of, but it's a good story into how building relationships can really provide opportunity. So we started the fund in 2018. It's a good story for investing as well. And there was there's a gentleman that, in fact, Richard had followed pretty closely, introduced to us. He was based in Greenwich in New York, just in Connecticut, just north of New York, and his name was Brad Jacobs. He wrote a very good book recently, very good entrepreneur. He's launched multi-billion-dollar companies, and we invested into a company of his called XPO Logistics.
Okay.
And I'll never forget this because we started the fund in 2018, and in December 2018, there was a real negative report that came out on this company, really bad, and a lot of it was nonsense. And the share we had bought at about $70, it fell to $35.
Oh, wow.
And you can imagine there was many late night phone calls, and we were stressing over this. And one of the, I mentioned earlier, is the big thing is that we like to speak to companies. So instead of panicking and selling, our research showed us that this report was wrong, but we needed to get further with this. So Gavin and Richard jumped on a plane, went to Connecticut, and actually sat down with the, one of the main guys, Matt Fazler, in those days, met up with the chief, one of the chief investment guys, a guy called Marc Blecher, and they literally took them through the whole business, every single thing. And I remember being in Melbourne and getting a call saying, Mark, we spoke, just keep buying. And the stock was $35. They actually then came out and announced a $2 billion buyback of their own shares, which is significant. And fast forward to today, if you look at XPO Logistics, let's say the stock sits at about $110 a share, but they've also spun out two other businesses. So that $35 that we were really compelled to buy, but also flying out, which compelled us to buy, if you tally up all those businesses, you're looking about $180 worth of value.
Wow.
Now, so that's a great example of not reacting to a share price fall. But what it did, and which really, which was great, and you don't really see impacts of building relationships early on. People want to build a relationship and get a response straight away, is we developed a really good relationship with their team. And through many years, we've just maintained the contact. Whenever we go to America, we chat to them. And then last year, we got this kind of headline that came out that said Brad Jacobs is actually now starting his next venture. Now, this is a guy that's run multiple ventures. All of them have become massive businesses. I think some of them have gone up 30x in value. One of them went up over 100 times in value. He was starting a new business, and he was calling it QXO. He likes the X's. He likes whatever it has. And we didn't think of anything of it, and we just sent a message to the investment team saying, well done on your new venture. And the next thing we get a call saying, hey guys, so sorry, do you want to be involved?
Oh, wow.
Now, this is a relationship that started in 2018, and suddenly in 2024, we get this opportunity, and we rate these guys so highly that we said absolutely. And it led to us actually getting involved in this placement on the ground level. They issued shares about $9.14 a share.
So this was at the raising capital. They allowed you to get in.
They allowed us to get in.
Yeah.
We also did a separate vehicle to take excess demand that we had for the stock from investors here. We got really good support.
Yeah.
And what this business was going into building product distribution, right? So building products from A to B, really fragmented industry within the US. Where Brad Jacobs and his team are excellent is taking fragmented industries and consolidating. That's what he's done throughout his whole journey. He started in the 1970s, and this is what he is doing now. It's extremely fragmented. We love the idea, and they call us all the time. And it's just a really good example of building relationships, doing your research, not just sitting behind a computer desk, can pay off in the long run. And this share has been very nice, been very good for us. It's more than doubled in value. We still think there's, amazing long-term runway for this company, and it's just great to be able to have that personal relationship with these guys to kind of add on top of the independent research we do as well. So that's kind of one example of how one share's disaster, which turned into actually a good investment for us, led to another investment many years later, just by being patient investors, long-term investors, and not rushing based on headlines.
Yeah, I love that.
Yeah.
Can you tell us a story where things haven't turned out as you thought, and how did you think through that?
Yeah.
And we all make mistakes, and how should investors think through potentially cutting losses maybe, or how they should
Well,
approach
I can
that?
talk you through two different types of mistakes. So during COVID, everyone was getting caught up in everything at home, and we're never going back to socializing. And we really liked the idea of Peloton, which was a in-home fitness regime. This is a good example of where a fantastic product doesn't necessarily mean a fantastic investment. And the share price was pretty high. It was sitting, I think we had bought them in about the 50s. The stock had run up nicely. But then as things started opening up, you could see that the demand for the products had dropped off. People were, suddenly moving back to the gym. And our mistake there was probably not being quick enough to get out of it, thinking that still this could be relevant.
Yeah.
It was a very tough lesson to learn. It wasn't a massive position for us, but any loss hurts.
Yeah.
And to see a position fall, we didn't get out soon enough, but it did set us up post that to understand better when you've got to get out of a position, and you've got to learn. Everyone makes mistakes, but you've got to learn from it, and you've got to learn how to apply that to future investments. The other mistake we made was selling NVIDIA. Right. And so there's an example of a company that is so relevant, most amazing business. Jensen Huang, I've followed him for years, and the business was doing so well. We had done very well in it. We got concerned about, I don't know if you remember, not even valuation. In 2022, there was, you already then had issues around chip supplies to China, restrictions. We weren't sure. We thought, well, it's very highly valued stock. Maybe it's going to get hit. So we ended up selling, and it could not have been a worse time to sell. And our second mistake was not buying back in. So, and those are lessons we've learned. It's lessons we've never repeated. And we've actually we've used those lessons for things like Amazon, where Amazon had a significant fall in 2023. We used those lessons to really buy a lot of Amazon when it fell to $80, $90. The stock now sits at $230 odd. So for us, as long as you learn, we all make mistakes. In investing world, you only have to get 60% of your investments right. You don't have to get everyone right. But the important part is letting the good ones run, not jumping out too early. And part of what I mentioned is we're very long-term investors. We're not a high turnover fund. Yeah. And I think it's probably an important aspect that many people don't realize is that investing in a high turnover fund means you actually have quite a tax liability outside of the fund. And what we try to do for our investors as well is, you can, if you invest and you get a 15% return in a year, but the portfolio has been turned over multiple times, you'll end up paying 30-40% outside of the fund. It's not because the fund doesn't pay it on your behalf. We try and minimize that tax. So for the last few years, we've really made an effort not to have much tax on our returns, and that's really by maintaining this long-term view of holding positions long-term. Doesn't mean we don't sell, because if things get overvalued, like I said, we're driven by that IRR, that internal rate of return. We will always sell. We're not going to worry about that, but we also don't want to jump out of stocks too soon if we feel they're at the early stage of their journey.
For those that are sort of getting, again, new into investing, a lot of my clients, especially the younger ones, are buying into ETFs where they, anytime they have money saved up, they're putting it into an ETF and so on. Take us through what does an ETF mean? Do you think it's a valid investment for those that maybe can't afford to get into Orsaro? Can you take us through what ETF investing is and whether there's a space for that?
Yeah, absolutely. I think ETF investing is fantastic. ETF means exchange traded funds. So essentially you are buying a pooled investment vehicle that is investing in the underlying index. So that every ETF is investing behind some either theme or an index. So my kids, when they were 13, I started putting money into the Vanguard index fund, and I'm not advertising for Vanguard here, but there's multiple ones out there, and I've done it as a regular. And as they've started working, I've encouraged them to do the same. Because yes, funds like us, you have to be a wholesale investor, minimum investments are higher, and it's a great way also to kind of set and forget. The beauty of ETFs is you're not worrying about the individual stocks. You're not worried that, if Apple has a bad result and the stock falls 5%, what does it mean for my investment if I'm holding Apple shares? And it really is a great way to compound wealth, especially for long-term investors. And there are other ETFs out there which track things like cybersecurity. There'll be ETFs that track cloud computing. There's ETFs that track countries. So if any investors out there are looking for something that they feel they want exposure to the Indian market that you can't get through traditional shares, an ETF is a great way to get access. If they want exposure to Europe or just to the NASDAQ or just to biotech, there are so many. But I'll give my warning again. There's ETFs, exchange traded funds, that are really good, solid ones, and there's also ones that are highly leveraged. And what you're seeing come out nowadays is kind of ETFs on certain aspects of the market that have 5 times leverage. Now, once again, that's great when you're going up, but when you're going down, that can hurt significantly. So just to be aware that, what you're buying needs to have, some of them do have leverage, and you just need to be aware of that. But I'm a big fan of exchange traded funds, and I'm a big fan of funds generally because it takes the guesswork out of choosing, stocks for yourself, especially when you don't have the time, and especially when you can't afford to get into the bigger funds.
And what's your view on, I think in the old days, I remember mum and dad, focusing on paying off their mortgage, or if they did have spare, once the mortgage was paid off, their focus was just to save and put money in the bank. And over the course of the last probably 3 to 5 years with, inflation, especially over during COVID, just growing so fast, cost of living growing and it being more and more expensive. As an investor and someone, you encouraging your kids to invest in ETFs or investing in the market, should we not be putting our money in the bank? And if for those that are trying to save up for their first home, where else can they put it? So what's your view on leaving your money in the bank, and what should they do, just even if it's the short term?
The bank's a tough one. Look, the problem now at the moment, and you said it, you're not going to keep up with inflation by keeping money in the bank, but having money in the bank gives you security of having short-term liquidity, where you don't need to worry about what if the market suddenly drops and I'm selling. My view is always, and it's the same advice, I speak to my kids about this and we always chat this, is that for money you need in the short term, and that could be a year to 2 years, you need to have liquidity in the bank. You can't look at the stock market as a 1-year investment. So for people that have excess cash and they do not feel they will have a need for that, and they're happy with their financial position and it's not going to put strain on them, you're far better investing that money. Now, that investment doesn't necessarily have to go into the stock market. It can go into any form of investment. But if you look at the historical averages of what performance you get through investing in global equities, which can be whatever, 11, 12% per annum, you're far outweighing your money in the bank. But you've got to be prepared that 12% per annum can be lumpy. You may have 1 year where you're down 10% and 1 year where you're up 23%. Yeah. And you need to take that into account. So the bank, I think, is very important for when you need liquidity and access to funds, and you don't ever want to have to sell an investment.
Because you have to.
But things outside of that, if you've got a long-term view, and look, for me, my long-term view is we invest in companies for 5 to 10 years. Yeah. So, we like to have a 5-year minimum time frame on investments. If you've got money that can go away for 5 years and you can keep adding to it, you are going to do very well for yourself over the long term if you compound that wealth. Our goal, one of the goals we have as a fund, is to grow in excess of 10% a year. It doesn't sound like a lot, but 10% excess a year, you double your money every 7 years. If you've got money and you've saved up money and you're happy to put that to work for that period of time, you're going to do very well. And that compounding just keeps growing exponentially. Suddenly you go forward 20 years. That's where you make your real wealth.
That's a trick that a lot of people forget, the compound interest. Do you want to very in a simplistic way explain the compound interest, how that kind of works? There's a rule of 78, the 10,
so normally it's
very basic
compounding is essentially it's interest on interest, or returns on returns. So stocks don't necessarily pay dividends or interest. You just get the growth in the value of the share. But if a company goes from $1 to $1.10 1 year, that's 10%. If it goes up another 10%, suddenly $1.21. Add on 10%, going up 12.1 cents a year. Add on another. It just keeps compounding. And that power of compounding, especially when you get out to the further years, or you have a year of 12, 13%, is significant. It's how some of the greatest investors in the world made their money. It's how a Warren Buffett or most of these guys have grown the wealth significantly for themselves and shareholders. Peter Lynch, one of the greatest investors on Wall Street, compounding, they've both said compounding is the greatest gift that's ever been given to investors. And that is why we love this idea of staying long-term investors, let compounding do the heavy lifting for you. Because as soon as you sell, let's say you make 10%, you go, that's it, I'm out. You got to find somewhere else to get that 10%.
Yeah.
Whereas if everyone loves to say, I should have bought Apple shares 10 years ago and never sold. No one does it.
No.
Because the stock goes up, they go, oh, hang on. But who does it? Guys like Warren Buffett. Why? He doesn't even look at headlines.
Yeah.
They just look at the business. So compounding is a great way, but you get it in the bank as well. but you're going to compound instead of 10%, you're going to compound at 2.5 through to 3.5%. So obviously it takes you a lot longer to double your money, and we don't think at 2% you're keeping up with inflation.
No. And the theme here really is do your homework, buy good stocks with good research, and have a sort of a longer time horizon.
Yep.
But again, you mentioned that thing around property, and I totally agree with you that, you know, people that invest in property don't have that little headline with the neon lights telling them every day what their property's worth. So the emotions around it are much less. Plus, getting in and out of property is so difficult. If you did want to sell your property tomorrow or that day, you can't, because you've got to list it, clean it. It just doesn't. So it makes you hold it. And I do agree that the reason that people that make money in property is because, one, it's a bigger investment. Generally, it's leveraged and held for a long time. People are forced to hold it. For those that we know now that, you know, having a long time horizon is the key, staying true, making sure that if you've made mistakes, you learn from them, and if you have to sell, you sell. But what advice do you have to your ordinary fella that, you know, does get emotional on the headlines? What tricks, tools would you give them to say, don't look at the headlines, turn off Twitter? Or what is it that you could say to the people there that, you know, try not to get emotionally attached to it and stick to it for the longer term?
It's extremely difficult because human emotion is one of the worst things when it comes to decision making. we all know those compulsive buys and everything in life. What I've done, and I've said to, and I'll talk about my family here, and I'm sure my sister won't mind me talking about her, but I've always said to her, if you ever worry, just give me a call, right?
Okay.
Right? You'll read a headline, you're going to see something bad. If it's ever a problem, give me a call and I'll be 100% honest with you. And this is a true story, I'm not making this up. In the beginning of April, she was told by someone to go sell every share she owned, go to cash, and in a super and everywhere. And she called me, she's like, should I? And I went, no, not only don't do that, change your advisor, whoever that was.
Yeah.
Because that is the worst thing you can. And I took her through the tax consequences of doing it. So I kind of explained to her exactly, this is what will happen if you sell. But not only that, you are selling at a point where you don't want to be selling. Switch off, stop reading, right? So what I would say to people out there, and it's easier said than done, honestly, is stop reading headlines on a daily basis, especially on social media. Social media has been one of the worst when it comes to really spreading panic, and go to your trusted sources. And even some articles in well-reputed websites and newspapers can be pretty extreme as to the market's going to crash and this could be the worst period. But just understand that this is not the first time this has happened, right? And so one of the best things I do is there's some great charts, which I'll happily send you, which show you essentially over the last 40 years, and the chart is called, over the last 40 years, there's always been a reason to sell. And it takes you through a chart of the index, how it's just gone from bottom left to top right, and little dots along the way saying World Trade Center attacks.
Oh, yeah, I've seen that.
.com.
And
Inflation
there's a little
worries.
down, there's a little dip.
And those little dips, and this is exactly what you're saying, they are so small and insignificant. At that time, they feel massive because it's a 20% correction. But when you look back over time, if you've just invested consistently and ignored everything in a good fund ETF, you end up making money. You know, there's the old saying, the longer you hold, the more likely you are to make money in the share markets. If you hold for less than a day, your chances of losing are like 50%. Once you hold for more than 5 years, your chances of losing are zero. And you need to always look back. So I always refer people to that. We always, whenever we have, one of the things we do as a fund manager, whenever there is bad times in the market, and April is a good example, we reach out to investors. We say to them, this is what's going on. We're going to have a conference call. We're going to take you through everything. And we will always highlight how historically, going back many, many, many years throughout history, there's always been a reason to sell, but it doesn't necessarily mean you have to sell. And it's important for, I keep that chart at the office and I always look at it when I get nervous. And I think to myself, well, let's see, is this, and you look at it and you go, every time, and I say, I've been around long enough, I can say I've experienced everything from, the inflation crisis in the 90s to tech wreck, September 11, GFC, European crisis. Remember when people were, not many people.
Greece was going broke.
Everyone was rioting on the streets of Greece. the world was
Italy
coming to an
having
end.
issues, yeah.
Remember Brexit and Grexit, and the Europe was going to break up, and then you had the inflation scare. I've been through them all, and all of those have been only one thing: a great buying opportunity. Yeah. And I've got to remind myself, and I remind investors and to people out there that are watching the market, if you're not leveraged, I always bring them back, and you're prepared to block out. We always say, shut out the noise. It's our slogan. Prepared to shut out the noise and just dollar cost average invest for many years, you'll be very happy in the long term.
Let's talk about AI. I feel like the world is evolving and moving, and I feel like people say in the next 5 years there's going to be industries that aren't going to be around, jobs that we thought we had and we're not going to have in the future. There might be some new jobs. I think this is going to bring amazing opportunities for new and wonderful products and new and wonderful services. Who is it that are investing in AI? If we wanted to take that AI wave from an investment perspective, who are the companies that are investing in AI? Is it to look at the top 10 tech companies? Is it your Amazons, Apples, Meta? Do we just invest in them and they'll take AI to the journey? Or are we looking for that little small, the guy that, the Steve Jobs when he was in his garage? I'm sure there's plenty of garage businesses at the moment. They're going to be worth billions. Are we going to try to find those? Or do we just go to so what's your AI strategy in trying to find the diamond?
It's a good question. And I think one of the frustrations we have is that when we started, companies that were coming to market or first IPOing were small. They didn't have the funding that they had today. So you had a real opportunity to find these real diamonds in the rough. And we've got great stories of businesses that have gone up 7 to 10 times for us because we could find them. The frustrating part, and this is what you said, is that the new companies now are getting so much money thrown at them by the big companies. So whether it's Microsoft, whether it's Alphabet, which is Google, whether it's Meta, whether it's Amazon, these businesses are investing billions and billions behind these AI startups, meaning that when they come into the market, these companies are worth already 20 billion plus in market cap. It makes it difficult. Doesn't mean there's not opportunities out there. So the way we've approached it is to say, well, we believe the big tech companies are going to be the guiding light for many, many years. Now, whether it's Alphabet, whether it's Amazon is a position we own, full disclosure, and we think it's one of our biggest positions in the fund. And we believe Amazon is pretty much got everything covered between AI, shopping, Prime Video. We think it's a great place for everything, and the investments behind AI are going to benefit them, benefit shoppers, etc. The amount of people that use AWS for their cloud provider, which for their AI tools is significant. So we've taken the view that we want to look at AI independently if the valuations make sense, but which is a great way to invest in it. And really, you kind of answered your own question there, is that between Meta, Amazon, Alphabet, you can get great exposure to the best minds in the world behind AI. And they are investing behind a lot of these small companies. So you feel you might get some value uplift that way. But it's pretty astounding. I mean, the AI wave is real. It's not a flash in the pan. It will change the world. We're seeing it already in business. Anyone who uses Subscriber or uses ChatGPT or any of them realize their productivity has gone to the roof. So what's the other way you play it? It doesn't have to be pure AI. How many businesses out there are going to see significant margin expansion because suddenly their cost, their employment cost, etc., is going to go down? We were listening to a conference call the other day where the CEO of the company said, in order to, and this is a big company in America, they will not hire a single employee unless they can be proven that that job cannot be done by AI.
Wow.
Now, that's quite significant because it means that that cost of doing business is going to drop, your OPEX drops, which means that's profitability to the bottom line. So there's also a way to look, are there companies out there that are going to significantly benefit it? And once again, your big companies, Amazon, Microsoft, the amount of people that are getting laid off, or just let's call it natural attrition, that they're not replacing people leaving is significant, which means these are companies that are operating at significant margins, and that's another benefit of AI. So there's so many aspects of it. Now, there'll be a lot of debate around ethically, what do you do? Is there a point where people aren't going to be able to have jobs because everything's done by robots and that? And that's a debate that's going to be interesting to play out, but that's many years away. But I was in Los Angeles meeting with some companies and I caught Waymo. Do you know what Waymo is?
No.
So Waymo is Alphabet Google self-driving taxi service.
Oh, yes. Yeah.
Okay.
Down anyway, yep.
It's amazing. The first time...
Did you go in one?
We went in one. Myself and Gavin very nervously got into our first one. I don't know if you know LA well, but we got in Santa Monica.
Yeah.
It was a 20-minute drive. And we were both sweating profusely when we got in, and there's no driver at all in the car. And you tap, I'm ready to go, and the thing drives. By the fourth ride, we weren't even watching the road anymore. We were sending emails, catching up on work. We caught a 40-minute drive, plays the music for you as you're driving, whatever you want. It's amazing technology, but what does that mean for driving for Uber drivers at some stage down the track? So there's a lot for us to weigh up, and I do think there'll be a lot of fantastic benefits of AI. There's going to be some real tough choices when it comes to AI. From an investment point of view, invest behind the big names is really good. There are a lot of great startups out there, but they're so expensive. People love Palantir is not really a startup, but people like CoreWeave and Palantir, but these are companies that are trading on 100 times sales.
Yeah.
And like I said to you, for us as a fund
manager, it's the idea, right?
It's the there's revenue. There's revenue there, and what's different between this and the dot-com era is that the dot-com era, there's no revenue.
Okay.
These companies are making significant revenue,
but they're just valued really high.
They're valued really high, and like I said earlier, is that valuation for us counts, and it may take a while for it to play out, but to invest in something at 100 times sales, it's just very difficult to foresee making money from that point onwards. So, we take we're not a super high growth, high risk fund, so we take a different approach, but definitely the ways to play it are through some of your big names. But we're keeping our ears to the ground, because what we hope happens is like what happened in the dot-com boom, where everything's up here, then things get hit down, and what comes out of that dust are the great leaders of the world. People forget that Amazon fell to under $1 a share during the dot-com bust. It's probably up 1,000 times since then, if not more, probably 20,000 times since then, if you identify the right one. So we always wait for the market to provide opportunity. AI is definitely going to be a big opportunity.
All right, now I cannot let you go. My last question is your thoughts and your sort of opinion on crypto and what you think, because we have I'll tell you what, Mark, it's 4 years ago, I reckon all my young clients, anyone under 30 was trying to be multimillionaire trading crypto, especially during COVID and that time. But now I'm starting to see more and more sophisticated type of thinking around crypto. I have my own opinion, which I won't share. But Mark, I'd love to know from a professional investor's perspective, what are your opinions on that?
We actually aren't allowed to invest in crypto, right? We can only invest in regulated markets, so crypto is not something we can invest in. And with me and crypto, me and crypto made a deal many years ago.
You knew what crypto did, okay.
I don't understand you properly, and I've tried. So I'm just going to watch you from a distance and enjoy. And it's been a fantastic investment. Bitcoin has been unbelievable, and I know a lot of people. And I get asked a lot, "What do you think?" And I say, as long as you do your research and you are comfortable with security of your money, and I think security is why people love it. Yeah. That's fine, and be comfortable. I was always nervous around what happens if my account gets hacked. There's no recourse. I like the fact that if money's stolen from my bank account, you got the government guarantee. There's all these type of things. It's done extremely well. I think what we're seeing now is this move from, like you said, you're getting more developed stuff. So, tokenization is a big terminology getting talked about now, where essentially it makes it easier to pay in real cash or in Bitcoin for real life dollars. One of the issues with Bitcoin many years ago, if you want to go and buy something at the local McDonald's, it's going to be very difficult to pay. So what you're seeing is this tokenization come through, and I think there's a few companies that do this. Circle Internet's one of them in America, but even MasterCard, Visa are now investing heavily in tokenization, which allows the use of Bitcoin, or other type of cryptocurrency. So what you're seeing is the cream rise to the top. Definitely the great, your Bitcoin, your Ethereum, Solana is the other one that's suddenly starting to move up nicely, and the people that believe in it, they're doing very well. And I don't begrudge it. I think that there are the people that know it well have done very well, because, like I said earlier, do your research. It's definitely here to stay. It's got a place in society. It's going to have a place in finance. And I think to just ignore it and say it's not, it's going to collapse. I think that maybe 10 years ago you could say that, but now I think it's really here to stay. What I don't get, and what I've never been involved with, and I think where people got burnt, was the whole, buying of the images and
the meme coins.
The meme coins, and that's pure speculation, and that is, to me, not something that I would even look at.
Well, Mark, thank you so much for sharing your knowledge to our listeners. You speak so well in terms of articulating the thought process of investing. And like I said, we have 19 years, and I always love catching up with you. You always ask, what you did before, especially before you went into Orsaro, as this is how you made money, how you made a living. Yeah. And I always look from a distance going, wow, I don't know how he does it. But you always had this calm demeanor about yourself. You would always come in, always calm regardless. And those calm pair of hands.
See me when I get home.
Those calm pair of hands have paid well. So thank you for sharing all of your insights in investing. And I wish Orsaro and yourself all the best.
Great. Thanks for having me. So
awesome.
It was great to catch up.